Good afternoon. Daniel Shu and myself will be walking you through Section 704 of the Internal Revenue Code, dealing with when partnership makes distributions of property with a built-in gain or loss, and we'll also be discussing the impact this has on a partner and a partnership. So the Internal Revenue Code, Section 704, deals with partnerships and each partner's distributive share in the entity. Partners can contribute capital, property, money, or services in exchange for an interest in the partnership. This interest represents their individual share of the entity's income or loss for the year. In this presentation, we'll be analyzing the event in which the partnership distributes property to a partner, and specifically the tax consequences when property distributed has a built-in gain or loss. We will also be defining what constitutes as a built-in gain and a built-in loss as well.
Now, we are going to try to break this down into simple terms. The purpose of Section 704C is to prevent taxable gain or loss inherent in property at time of contribution from being shifted to another partner. There are quite a few moving parts that are going on when it comes to the purpose of Section 704C. Let's assume that property has a built-in gain or loss at time of its contribution to the partnership. In order to prevent taxable gain or loss inherent in property at time of contribution from being shifted to another partner, the first dollars of gain from the sale of property are allocated to the contributed partner until the contributed partner has recognized all of the pre-contribution gain. Now, we are going to illustrate essentially what the purposes of Section 704C is with multiple examples and illustrations. But keep this in mind. Anything associated with that property is allocated first to the contributed partner. Now, when it comes to treatment of sales, Section 704C states if property is distributed within a 7-year period to any partner other than the contributing partner, it's treated, unfortunately, as a sale. This forces the contributing partner to recognize any gain that was inherent in the property at time of contribution to the partnership, and ultimately it alters the inside basis of the property prior to it being distributed. Other partners may not be affected by the deemed sale, though. Ultimately, there is an anti-abuse rule in Treasury Regulation Section 1.704-7F, and it basically states that if a principal purpose of a transaction is to achieve a tax result that is inconsistent with the purpose of Section 704, the IRS can recast a transaction for federal income tax purposes. If you form a partnership, I strongly advise to be aware of this anti-abuse rule set forth by the Treasury Department. One of our examples essentially is detailed with two individuals, two companies. Our assumption is T company and B company form a drug manufacturing partnership called Z on January 1st, 2019. In addition, each partner owns a 50% interest in the partnership. T company contributes a drug patent with a basis of 2 million and a fair market value of 10 million. In return, B contributes its stock with a value of 20 million. on January 15, 2019, let's assume the patent is distributed to B company. Now, essentially with this example, the patent that was distributed is treated as a sale, and B company would realize a gain of $8 million. Now, the point of this example is to illustrate the prevention of income shifting from T company and B company. In addition, it is to prevent the deferral of gain. If it wasn't for Section 704C, B company could, in theory, manufacture drug X under the patent indefinitely, and the gain may never be taxed as a result. Now, this illustration is representing our example. Run the assumption that these circles represent individuals, and these squares represent corporations. Ultimately, the triangle will represent a partnership entity. As you can see, T company contributed a patent of 10 million fair market value with a basis of 2 million. And B company contributed 20 million in stock. As indicated by our example, the patent distributed would be treated as a gain, and ultimately B company would recognize a gain of $8 million.
All right, thank you, Daniel. Now we're going to talk about property with built-in loss. So to determine if property has built-in loss, we must look at the property's basis, i.e. what the specific partner has paid for such property, and compare that to the property's fair market value. So the Internal Revenue Code section 704C1C states if a partner's adjusted basis, that basis minus any depreciation, basis exceeds the property's fair market value at the time of contribution, then there is a built-in loss. Treasury Regulation 1.704-3 states it similarly, in that if a partner's basis is greater than the property's book value and the property is put into the entity, there's a built-in loss. Another way to look at it is if what you paid for the property is greater than what it's worth when you put it into the entity or the partnership, you will have a loss upon the sale of the item. Now, for the partnership side of things, the partnership's basis in such property, they will record it at its fair market value, even though the partner still has to recognize it as their original basis. So let's take a look at an example here. X, Y, and Z are all individuals, and they decide to form a partnership. So X contributes property X, which has a fair market value of $5,000, and X's basis in the property is $20,000. Y contributes property, fair market value and basis are equal at $20,000. Z contributes cash of $20,000, so his basis is and fair market value is $20,000. And so they're equal partners, and they have an equal interest in the partnership. So in the future, 5 years later, partnership decides it's going to distribute property X to Z to liquidate Z's interest in the partnership. Now, going back to what Daniel said previously, since Z was not the contributing partner of property X, the partnership and partners will have to recognize this as a sale. So now X would have a loss of $15,000 because this is the amount his basis exceeds the fair market value, $20,000 minus $5,000, and they would have to recognize the loss on this transaction.
Property with built-in gain under RRC 737. If a partner who contributed property to a partnership receives a distribution of property, other than money in this case, from a partnership, then the partner needs to recognize gain equals to the lesser of the excess distribution or the net pre-contribution gain. Let's look at an example. A and B form PPLLC on year 1. A contributes an improved real property AA with basis of $10,000, and fair market value of $100,000. B contributes an improved real property BB with basis and fair market values are the same as $100,000. On June 30th, year 2, when A's basis in her partnership interest is $100,000, PP distributes BB to A in the current distribution. Property BB is worth $110,000 at that time. The excess distribution is calculated by the fair market value of the property BB, which is $110,000 over A's basis in her partnership interest, which is $10,000. So $100,000 is A's excess distribution. So A's net pre-contribution gain is $90,000, which is the property AA's basis and the fair market value. So A is required to recognize $90,000, which is the lesser of the two. So the recommendation for the partners is who holds appreciated or depreciated property from transferring the property to a partnership. They need to be aware of there would be some built-in gain or loss under IRC 704C, where a partner may have to realize gain and pay tax, or they may suffer a loss when the property loses value. So now you have a better understanding of distribution of property with a built-in gain or built-in loss under 704C. And thank you very much for listening.